The purpose of this video is to introduce the short-run aggregate supply curve, right here. The supply curve is upward sloping. We have current inflation here, we have output here, we have potential output here, which is where the economy is at what we call full employment. It's utilizing all its resources without stress. It's not overproducing, it's not underproducing. It's a long-run sustainable aggregate supply curve. So it's a long-run aggregate supply curve. We start off right here at equilibrium. And what we want to do is first explain the slope and then the shifters of this curve. The slope of this has to do with sticky factor prices. And I want to be careful here. First, I want to define what a factor is, then a factor price. A factor is an input used in the production process that gets used over and over again. It doesn't get used up. So an example of something that gets used up is steel in an automobile. Well, once the steel is put into the automobile, it's used up, it's gone. You can't use that steel in the next car on the production line. With labor and capital, like equipment and land, you can keep using the same labor over and over again to produce multiple cars, the same equipment to produce multiple cars in the same land. That's what we mean by factors of production. And the main costs of factors of production are called wages, which is the price of labor, and then rent, which is the price of capital, including land rent. So wages and rent are factor prices. So the story goes like this. This is upward sloping because as inflation goes up and you start moving in this direction, right? Inflation goes up, businesses produce more. They want to produce more. And the reason for that is their profits are increasing. Let's look at the income statement of an individual company, and then you can aggregate it in your head and scale up to the overall economy. There's sales. It's made up of P times Q, the price of whatever is being sold, the product, times quantity. So this is a good or service here. That's basically what we're measuring in terms of price increases on this side. This side, to make sure we're clear here, this is the price of goods and services that are increasing, this inflation. It's not factor prices. So here we have, at this point, we have product costs here. So this is product cost. Then we have cost of goods sold. We have gross margin, selling and administrative expenses, and then profit. Now, this is perfectly flexible. Product prices are perfectly flexible here, so this is perfectly flexible. So when inflation goes up, P goes up, right? But then we have these sticky wages and sticky rent because most people don't get reviewed for a year or more, especially if you work for a union. And so over the short run, prices are sticky in terms of wages, wage costs. And then rent, which often is contractual for a year or several years, that doesn't change either for the most part. And so if prices go up, but your costs are somewhat constrained, not all the costs, some of the costs, like for various supplies will be changing along with inflation, but for the most part, these cost of goods sold, they'll be somewhat sticky, including the selling and administrative will have some stickiness in here because wages will be embedded in there and some rent will be embedded in there also. So if prices go up but your costs are constrained, then your profits go up. When profits go up, firms are going to want to produce more. And that's what's going on here. This is what firms are supplying. Now, if prices go down, inflation goes down, you move in this direction, this works in reverse. This process works in reverse. Okay, so that's the slope of the supply curve here. It's a short-run supply curve because ultimately we're going to end up on this long-run supply curve because prices of everything will be fully flexible. Eventually, these sticky prices, in terms of sticky factor prices, I should be clear, sticky factor prices, they eventually become unstuck and are flexible. but it takes time. Now, let's move on to what are the shifters for this short-run aggregate supply curve. The first thing we want to realize is this curve shifts because this curve right here has embedded in it a certain expectations for inflation. It has inflation expectations built into it. And we label that pi E, E for expectations. And when we're right here, by the way, pi, current inflation, the current inflation rate, as I marked here 2%, equals what people had expected the inflation rate to be. So people had expected a 2% rate. It's actually 2%. It implies we're in equilibrium. There's no tendency to change. What we expected is what we got. Now, let's say that businesses start seeing inflation going up and they produce more and more output, and we move up this line. What that is going to cause is it's actually going to cause a shift in the supply curve. Supply curve is going to go up. Now, sometimes I label it as a left arrow, but it's probably better to think of it as going up in this particular circumstance. If prices were fully flexible, we'd go from this point 1 right up to this point 2 right here, right up here. But prices are not flexible for all prices. The prices of labor and the price of rent and capital is not fully flexible. So we move out in this direction. So now the important point to realize is that how are inflation expectations set? Well, it turns out inflation expectations are set based on past inflation. So what I'm doing is we're looking at time 0, 1, and actually 1 year back. So here's a year ago, here's the future, and here we are right at time 0. So the way people look at inflation is they say, okay, inflation was 2% last year. I'm going to project it to be 2% this year. And so it's sometimes called adaptive expectations. Whatever happened last period turns out to be what we forecast for the next period. And we set our prices. Businesses set their prices based on those expectations. But things can shift and surprise us. So this is how inflation expectations are set. So this is based on a certain set of expectations. And then as we see, for example, let's draw in an aggregate demand curve. So we have a dynamic aggregate demand curve. We start here in equilibrium. There's a shock in aggregate demand. And so we go up to aggregate demand this way. We go out with the aggregate demand curve. That could be, an increase in optimism in the economy. Consumption and investment goes up, net exports go up. Let's just call it optimism, something unrelated to inflation. So optimism goes up, the aggregate demand curve shifts out. Businesses start to produce more goods and services, but we're beyond what the economy can normally produce at full employment. So we start to see some bottlenecks and pressure in the economy, and prices start to go up, but some of them are sticky. So what happens is prices don't fully increase. Prices may only go up to 2.5%. But given the jump in aggregate demand, the increase really should be 3%. So we get at point 2, which is pretty easy to see, but how do we get to this point? We have to get back to this equilibrium point because remember, we always have to end up on this line. It's the long run. So what happens is inflation expectations go up because past inflation just went up. Inflation just went up, and if inflation just went up in the past, this is now 2.5%, then it's going to go up 2.5% again, expected to go up. It's expected to be 2.5%. We're going to get a gain that causes us to move up to this point. So all in all, we see that, look, inflation went up an extra 0.5% here, and it went up an extra 0.5% here to a total of 3%. It took 2 legs to go up 1%. Whereas if prices were fully flexible, they would have went from here to here very quickly in one jump. Now, had there been an increase in pessimism in the economy, the aggregate demand curve would have shifted to the left, we would have slid down this short-run aggregate supply curve. Firms would produce less because their prices would be fully flexible and they'd be falling, but their costs would be fixed, their profits would go down. So we'd be out to here, we'd be at a point here, and then expectations, since expectations are adaptive, the fact that prices have dropped in this period will mean that people will expect prices to drop again. They'll actually expect them to drop, and we'll move back to a new short-run aggregate supply curve down here, and we'll have an equilibrium, long-run equilibrium, somewhere around at this point at a lower rate of inflation, which kind of makes sense. So did you catch the mistake I made? In fact, I made it twice in the past minute or so. I didn't notice it when I produced the video until I went back to edit, and then it caught my attention. It's a very subtle error on my part. And the error is this. I talked about a drop in prices when the demand curve moves off to the left. It's really a drop in inflation, disinflation. If I had P on the vertical axis, then I could say, look, prices have dropped. But I can't say that. Inflation is reduced, is what I should be saying. Very subtle. It's easy to overlook. But I just wanted to make the point. Now, let me get back to the original material. Now, there's another reason for this curve to shift up, and it's a little easier to see, and that's when input costs go up, including factor costs. So to me, that's relatively straightforward, because imagine if prices were fully flexible, you'd run right up that long-run aggregate supply curve straight up. And so you can see when input prices are going up, that short-run aggregate supply curve shifts up. And when prices come down, input prices come down, then the short-run aggregate supply curve will shift down, straight down. So at this point, it would be instructive to show you another short-run aggregate supply curve that can be modeled. And you may have seen this in your introductory economics course or some other economics course, where you have the price level here, like I showed you in a previous video. You can have the price level instead of inflation. On this axis, we're still going to have potential or full employment GDP, which is the long-run aggregate supply curve. And then what we could have is something like this, a short-run aggregate supply curve that really is a curve. And what this model is telling you, and I think it's pretty cool, is that look, if you start to go into a recessionary gap and you start to get unemployment, you move in to the left of full employment, you're going to get price declines, but probably not that much. And so the slope is relatively flat. Look, even when we had the coronavirus and we got in the pandemic and we moved well off to the left here, prices in April of 2020 fell about 1%. And if you look at it for March, April, May, overall prices didn't decline very much. So we had a little bit of negative inflation, but it's relatively flat for the most part. Now the story's different if we start running above full employment, because then we start running into bottlenecks in the economy, especially when it comes to labor. We get labor shortages and we get raw material shortages. So when you start moving in this direction, you end up hitting a brick wall, so to speak, at output about here, because once you get to an output level at this point, all you're doing is you're getting higher prices. You're not getting more output. How much more can people produce? There's a limit to how much we can physically produce given the amount of capital and the amount of, when I say capital, equipment, property, plant, and equipment, and even human capital, people, employment. So that eventually causes us to run right up against this brick wall, and we go up this short-run aggregate supply curve. So my point is to show you that there are other models out there using a short-run aggregate supply curve. It's back to that price level, so this is really common to see this in textbooks and on the internet. But a short-run aggregate supply curve like this, yeah, there's something to that, and you should be aware of it. Now let me get back to the model at hand, to this graph. How do you know how far to go up? How do you know that we end up here? Well, think about what happens if you only go part way up. The short run aggregate supply curve only stops in the middle here. Well, we still have a strong economy with inflationary tendencies. We're beyond the capacity, the long run capacity of the economy. So there's still going to be pressure for prices to go up. So people will still expect prices to go up. And when they expect prices to go up, they're going to shift them up this way. And then we'll get to the point where current inflation will equal expected inflation at a later point. So current inflation will equal what's expected that's built into this supply curve. Now what happens if we go too far? Why can't it go here? Well, if we went here, then we'd be in a deflationary gap. We'd be having, at this point, we would have unemployment. By this amount, we'd have unemployment, we'd be below potential, and that would have pressure for price expectations to go down. So this will oscillate until you end up right at that point where current inflation equals expected inflation. Now, there's two more things I want to cover here about this model. And the first thing is, whatever changes potential GDP, full employment GDP, and moves it out a little bit, will also move this short-run aggregate supply curve out over time. And so the two will march off across this graph about roughly at the same inflation level. So if you imagine these two lines shifting out, then the equilibrium would be further out here, and you'd be about at the same 2% inflation rate. That's basically how we have been going in this country for many years. We may oscillate a little bit about the 2% inflation, but we're basically moving out here. So the point is, whatever changes this full employment, and remember what can change it. If the population increases, this can go out. If there's an increase in labor productivity, this can move out to the right. And even if the labor force participation rate increases, in this country, ballpark, the labor force participation rate is about 60%. So 60% of all the people in the United States are working, and 40% don't work. 40%, that could be retired people, that could be children, that could be incarcerated people, but 60% work. So if that labor force participation rate jumps up to 65 and more people start working, that's going to cause this to march out. Obviously, when we stay at this 2% inflation rate, the aggregate demand curve, because people are demanding a bit more, they're producing a bit more, and everything's moving out in an equilibrium about on this line here. Now, the trick is that what drives this potential drives this short-run aggregate supply curve, but what drives the short-run aggregate supply curve doesn't necessarily drive the potential. It doesn't work the other way around. And a good example of that is this expectations shift. If expectations shift, you just go up to a new short-run aggregate supply curve. Nothing's happened to this long-run potential. This long-run potential is fixed and constant. The same thing with input prices. If input prices go up, we shift up this way. Nothing is happening to this line. With that understanding that shifts in the short-run aggregate supply curve don't necessarily cause shifts in the long-run aggregate supply curve, needs to be qualified. Some economists will model the oil shocks of the 1970s, which shifted the short-run aggregate supply curve up to the left for a long period of time, actually caused the long-run aggregate supply curve to shift to the left. So the point of contention among economists for modeling oil shocks of the 1970s is that we were in a point of stagflation. It's called stagflation, a stagnant economy with inflation. Normally when you're left of the long-run aggregate supply curve, you're in a recessionary gap and prices tend to go down. But prices went up because we got hit with an increase in oil prices. What happened was we were in stagflation for so long, several years, that some people model it as a shift in a long-run aggregate supply curve to the left. Really what it boils down to is semantics. Is a couple of years the short run? I don't have a good answer for that. I often get asked in class, well, what's the difference between the long run and the short run? And the best I can do is tell you that the long run is longer than the short run. It's never defined in these models as to what's short run and long run. You have to use your imagination. So the point is, we were left of the long run aggregate supply curve for a long period of time, several years. And the question is, well, did that really shift the long run aggregate supply curve to the left a bit? Or do we just model a disequilibrium, which means we were in the short run for a couple of years? It's semantics. I'll cover the oil shocks of the 1970s and stagflation in another video. Let's continue with the story here of the short run aggregate supply curve. The other thing to keep in mind is we are at a long run when we're on this line. You know that already. But it's wherever the aggregate demand curve meets the short run aggregate supply curve is where there's an equilibrium in the economy. And if it's not on this line, it's only a short run equilibrium. So the moment this aggregate demand curve starts to shift out along this aggregate supply curve, we're off the long run and we're into short run territory. These deviations from the long run are all short run. And things are going to have to snap back to this point. So you often will hear, the textbook will mention it, that it's where these two lines intersect, the short run aggregate supply curve and the dynamic aggregate demand curve meet. That's where the economy is in an equilibrium, but it's not long run. So we've built out the aggregate demand, short run aggregate supply, and long run aggregate supply curves in a series of videos. Now what we want to do is in the next video, let's look at some actual situations that the economy has gone through and see how it all worked out.